Welcome to my presentation on index investing. In this video, I will first explain what index investing is and how it can be very beneficial for your investing experience. But more importantly, I want to dive into an ETF called SOXX, which essentially is an ETF tracking an index of semiconductor companies. So S&P Global defines an index as a group or basket of securities, derivatives, or other financial instruments that represents and measures the performance of a specific market, asset class, market sector, or investment strategy. So indexes have various uses. They're used by economists to track inflation with the CPI model, for example. But in investing, an index is essentially used to compare your portfolio's returns to what's called the market. When people are referring to the market, they're usually referring to the S&P 500 index. The S&P 500 index essentially tracks all US Fortune 500 companies and is weighted based on market cap. The S&P 500 has yielded about a 10% yearly return on average, and if you wanted to purchase into an index fund, you would buy an ETF that tracks that specific index. So what are the benefits to index investing? Index investing gives you diversification, which is one of the oldest principles of investing. By purchasing shares of an S&P 500 ETF, you're essentially buying shares in 500 different companies. This also means it's a much more passive investing style. By purchasing a broad index, you don't need to spend the time listening on individual company earning calls, reading annual reports, or press releases. With an ETF, everything is managed for you for a small fee. You can purchase shares and not give it another glance. Lastly, index investing is less volatile than purchasing individual stocks. With individual stocks, you might experience wild swings, which could worry some people. Something I found funny was Warren Buffett. He's one of the greatest investors in the world. He once made a $1 million bet against a hedge fund investor saying that the S&P 500 would outperform his fund after 10 years. And Warren Buffett ended up winning the bet and donated all the winnings to charity. But this just goes to show even very educated investors struggle to outperform the market over time. So there's really no shame in buying into an index fund, even if you're an accredited investor. Now, before we get into the SOXX ETF, I have a business quote here. During a gold rush, sell shovels. And no one knows who said it, but it was a saying during the gold rushes in America. So no, Vanderbilt didn't say it, but he's a businessman that executed on it really well by profiting off the transportation of people to Alaska and California during the gold rushes. So this ties perfectly into the ETF I'll be showing today, because I believe it's the modern equivalent of this quote. So SOXX is an ETF that tracks various semiconductor companies. Semiconductors are the chips that your phone and computer need, and they essentially are the backbone of everything technology. SOXX has 30 different holdings, and you might even recognize a lot of these companies because they've had huge run-ups in the last couple of years. SOXX encompasses the entire supply chain of semiconductors. They have massive holdings in ASML, which is arguably the most important semiconductor company right now, because they have a monopoly over lithography machines, which are the machines needed to manufacture semiconductors. TSMC specializes in the actual manufacturing of semiconductors, using designs from their clients. So TSMC buys off ASML, and TSMC manufactures it the way their other clients want it manufactured. So their other clients can be other semiconductor companies or big tech companies. This is an extremely expensive and challenging industry to break into, so these companies specialize in their function in the supply chain and generally have large market share. All of the popular and major technology companies rely on services and products that SOXX companies provide. Semiconductor companies are essentially the benefactors of the newest trends and fads such as cloud computing, AI, electric cars, VR, biotech, and the military-industrial complex. Stuff like ChatGPT wouldn't be possible without advanced semiconductor chips. So this ties perfectly into my quote I said earlier. Semiconductor companies are essentially the new shovel sellers. New trends like AI, VR, and electric cars are risky ventures with the potential for huge returns. But by investing in semiconductor companies, you're profiting from all of this with a whole lot less risk. It's very comforting to see that the major customers for semiconductor companies are the largest companies in the world by market cap. This proves how important semiconductor companies are, not just for the tech industry, but the market as a whole. These players have deep pockets, so investors can be assured that these customers won't be going out of business. Now we're going to get into historical price returns here, and this graph shows SOXX performance versus the SPY. As you can see, SOXX is extremely volatile, but massively outperforms the market over the long term. This is because semiconductor companies are a cyclical industry. They also need to spend a lot on capex in order to stay relevant. This means there will be periodic times of stagnation or even declining earnings, but during bull markets, SOXX will massively outperform. This is a pretty scary graph to look at. As you can see, between March 23rd, 2020, which was the start of the COVID pandemic, to December 28th, 2021, SOXX gained 200%, or 113% annualized, and then lost 45% between December 28th, 2021 and October 17th, 2022. This is what's to be expected when buying into an ETF like SOXX. To show the price return, I built a little calculator in Google Sheets. Essentially, I just input the ticker symbol in the dates. I have December 30th, 2012 to December 30th, 2022 because I want to see the 10-year return. This model produces the prices on the dates and then inputs this formula to give us a price CAGR. So we get a CAGR of 20.91%, which is pretty massive. It also gives the SPY return over the same period of time, which comes out to 10.38%. So SOXX has massively outperformed the SPY over the last 10 years. The total return for SOXX has 22.62%. The total return accounts for dividends paid. SOXX pays a small initial dividend yield of 0.86%. It's very small, but that doesn't matter at all in my opinion. What surprised me about this ETF was the high dividend CAGR, which is at 9.04% over the last 5 years. This means every year the dividend increases by 9% on average. So while the initial yield is small, you can have a massive yield on cost over the long run. As you can see from the chart on the top left, there are moments you could have invested during where you would now have over a 10% dividend yield on cost. All of these dividends coupled with the insane share price appreciation sounds like an amazing deal to me. Something you should note, though, is that these dividends aren't reliable. While some companies may pay a consistent dividend every quarter or year, others will pay special dividends or pay an inconsistent amount. So what's promising about SOXX's future? Analysts have forecasted 12.28% year-over-year growth for the semiconductor industry. This is due to our growing reliance to technology and urbanization happening all over the globe. These businesses are mostly high-margin businesses when compared with other industries such as food or real estate, due to the challenges in breaking into the semiconductor industry. We call this an economic moat. Many of these companies have monopolistic features because they don't face much competition in their function in the supply chain. This allows them to have high margins and gives them leverage when negotiating with customers and clients. Another massive tailwind for the industry is the US 2022 CHIPS Act, which provides roughly $280 billion in new funding to boost domestic research and manufacturing of semiconductors in the United States. Basically, the US wants to encourage semiconductor manufacturing in the US because they realize how important this technology is for becoming a dominant global leader. In my opinion, this ETF is perfect for young investors with a long time horizon. A grandpa who's 10 years retired doesn't have the time to hold through business cycles and for their yield on cost to grow. But young investors with a long time horizon will be able to fully realize the upsides of this industry, which is a high dividend yield on cost in the future and market outperformance. Investors need to expect stagnation and volatility when they buy this ETF. This ETF has an overall PE ratio of about 26, which is a fair number in my opinion. As I said before, these are companies with wide economic moats, so a premium for the shares should be expected. But something that you should note is that some of the top holdings in this ETF, such as Nvidia and AMD, have very high PE ratios in the hundreds, which could mean that too much future earnings is priced into the stock.